Welcome to Flipping Out with your host, Paul Ezell, your leader in virtual wholesaling and investing in today's real estate market. Each week, he will be joined by some of the biggest players in the real estate space who will share their experiences, knowledge, insight, and tips for making it big in the industry. And now, here's your host, Paul Ezell.
How would you like to have a full or part-time business that allows you to create a flexible work schedule around your busy lifestyle? Would you like to earn between $60,000 and $500,000 annually working from the comfort of your own home? If so, then virtual wholesaling may be the business for you. Contact us at reoauctionacademy.com and find out how to get a jump start on building a cash flowing machine without the headaches of dealing with contractors and homeowners. With an investment starting as low as $7,000, you can be well on your way to living the virtual investing lifestyle of your choosing.
Hello, everyone, and welcome to another episode of Flipping Out. This is Paul Ezell, your host, and today I really want to get into a lot of housing market data, right? This is going to be a solo cast. This is just me. I'm going to go on a long diatribe about where the market is now. This is all my personal opinion, where the market is now, where it's going. We're going to look at a lot of numbers, and we're going to show where those numbers are taking us, where they're leading, and what the market's going to look like. We're now through quarter one of 2022, what it's going to look like for the next 3 quarters and possibly into 2023. The different factors that could come in and change the market, and some could change it rather quickly, as we've seen with interest rates really going up from, say 2 3/4 in January, early February timeframe up to 5.11 as of April 25th today. So the rates have definitely jumped, and what that's doing right now to the market. Obviously, there's a lagging effect that we can't see yet. The numbers I'm looking at are mostly based on lower interest rate numbers. However, March, the rates did drop or increase quite a bit, and a lot of data here coming from March. So they're, again, rates lock 30, 45 days. You could go as far as 60 if you pay additional points. So there are rate lock features. So again, we're probably looking at more lower interest rates. So we won't see until May data comes out, probably what the true market is as far as price, where things are heading. But I want to try to give you my opinion on where things are, where they're heading, and where I think it's going to lead us here into the future. And if now is a good time to be buying, selling, both, or sitting on the sidelines waiting to figure this out. All right, so we're going to dive into the numbers here in a moment. Okay, now I'm going to jump into a screen share. For those that are on YouTube, you're going to be able to follow me here. But for those that are listening on audio here, I'm going to try to explain as much as I can so you don't have to go back and revisit here on YouTube. So mortgage rates have obviously shot up here to 5.11%. And it's a 30-year, it's on a 30-year mortgage. I think it's around 4 1/4 on a 15-year, which is very, very high too on a 15-year. But this is the highest level on a 30-year mortgage since 2010. And 2010, the housing market was very poor, right? That was shortly after the financial crisis. Inventory was high. This is a totally, totally different market than what we were in there. People that are qualifying are good qualified people. Back in the 2004, 5, 6, 7 leading up to the financial crisis, they were not good quality mortgage applicants. So what has happened here with the rates increasing? How has that changed things? So we've had a fairly, not substantial, but there's been a drop. Fewer people are starting online home searches, right? And fewer people are applying for mortgages right now, because I think a lot of people are like, all right, let's wait a month or two, see if rates drop. And if rates do in fact drop, then maybe we'll jump back into it here. But it's put a lot of people on a sideline, and I can't necessarily blame them, because I'm trying to refinance a few things as well that I've been working on. So I maybe, pardon me, I'm maybe going to wait as well for another month or two, because I do think the rates will come back down. I think a lot of this is maybe driven by the Russia-Ukraine war that's going on there. And a lot of the uncertainty in the world has pushed up the rates, plus the value of the dollar decreasing. It's actually gaining strength right now. But obviously the 10-year T-bond is being bought at the same level it was before, because that's what drives the mortgage interest rates here. The short-term rates, they just bumped up a quarter. They're probably going to do a half a point again here in May. We'll see what that does to the long-term rates. Usually that they don't necessarily correlate together. They're two different things, but we'll see what that ends up doing here with the long-term rates here. So how is this affecting new listings? So 1 in 8 sellers have dropped their home prices, right? That's not very many. I mean, in a normal market, you're probably 4 or 5 of 8 people dropping their home prices. So this is still low. There's a 7% drop in new listings. Not a huge drop again, but it's dropped people that were thinking, maybe I'll wait a little bit and see if the rates drop a little bit so I can get more people interested. They don't really need to do that. They don't understand how little inventory there is on a market and how much it's affected here, because there's so many record highs right now. Record 54% of homes sold above listing price. Last year, same time, April here, 2021, only 44% did. And when I say only 44, I mean, it's a hyperbolic market. So the fact that anything is getting bid this much over market just shows the lack of inventory. And we'll get in that later. I pulled up a lot of great housing data off of Redfin here that we're going to go through. And we're going to run through all these things, but only an average of 3.3% of homes have a price drop, right? That is extraordinarily low. And I'll give you, for instance, a property that I've had on the market for just under 30 days. Where your average, I think, is going penny within 15 days or less. But this one has been about 30 days, a little more difficult because it's right up against the turnpike. So you got noise factor. So a lot of buyers don't like that. And it's listed at 289.9. I had an offer 265, and that was for a while the only offer that came in. I decided to hold off on that one for a while. And good thing I did. And my gut told me to hold off here for a little bit and just wait, because there's enough demand out there that eventually I'll get a higher price offer. This isn't your typical slower market where you take what you can get. So I had an offer come in at 290 today. So huge difference, right? That's a huge difference, extra $25,000 going to my pocket on a resale of a property here because I had patience to wait. So that's kind of where we are in the market. So don't necessarily jump the gun at the first offer that comes in there unless it's great, meets all terms, meets what you want, and is a really strong buyer. So you don't have to do that. So this is just the way the market is. The numbers are showing it. It's totally crazy. So don't rush and accept the first buyer that comes in unless it meets all the terms that you're looking for. Okay, now we're going to jump into some different things here. I want to get in again. I apologize. This is from the 31st of March, the first thing that we're going to look over here. So this is a little bit dated already. That's how quick the market is moving, but I still wanted to hit these numbers so you could take a look at it. So the median home sale price was up 17% year over year to a record high of 382,713. Prices are just jumping so quick. It's really, to me, it's mind-boggling almost. So this is where the increase in interest rates, long-term, obviously the mortgage rates, are going to bring this number down, stabilize it potentially bring it down, but at least for the near term here, stabilize it. So up 17% year over year from last, and the biggest jump since August 1st, 2021, which is, the end of your peak sales cycle in real estate. Your biggest, in general in the US, your biggest months are going to be June, July, and August. Really, May kind of comes in there too, but the start of the spring season obviously is March. That's when you start to really see things. This has been an extremely different year. That January and February set records, right? And that's just because lack of inventory. So numbers are going to get pushed up. This is when the rates were going back here to in a March 4.67. Again, they're up not super quick. 3 weeks they've gone up close to 0.5%, not quite 0.5%. So pretty big jump, because they were up from 3.8% at the end of March of 2021. And obviously when you get into higher priced homes, it really pushes the cost, your mortgage cost up. And we'll get into that a little bit later. But 51% of homes sold above list price, up 40% from a year earlier. A record 45% of homes went under contract within 1 week. That's 3 percentage points, up 3% from a year earlier. So really things moving even quicker than they were before. The average, this is a very interesting one. The average sale to list price ratio was 102%. So in other words, 2% above asking price. Last year, at this point, it was just barely over asking price, 100.2. Again, showing what a hyperbolic market we're in here. And if you look at 2022, and this is kind of what I thought was going to happen, and what I was worried about potentially happening to cool it off is potentially happening right now, the interest rate. So if you look at 2020, right? Weird year, obviously, with COVID and everything, but you saw this more slowly went up. It went up pretty crazy, but more slowly, and then dropped off very oddly. So February, March, April went up pretty nice, dropped down in May and June. Very, very odd. You don't normally see that. And then really took off once people started. Well, I mean, this was normal. It dropped off because it was 2020, right? This was COVID right here. Lockdowns happened. People were scared. They didn't know what was going on. Prices dropped initially. I thought they would drop too. Like, this is just where I thought. And then it went parabolic up. It really increased through 2020. Then you go to 2021 and you get to February, you were locked down here in January, a lot of us, especially people that were up in the Northeast. And then it shot up unbelievably, right? From, say, call it mid-February all the way through July and in August. And then it settled in normal. Fall market slows down a little, but then it picked up oddly enough at the end of the year, November, December. Very, very odd. You don't normally see that. Carried through early into 2022 here. This is why I thought when I saw this happening at the end of the year, the increase in November, December, this is why I thought we'd have a parabolic year, that 2022 would be crazier than 2021 by a bit. And all the numbers put out there by realtor.com, I thought were bogus, like a 6% national increase. They were only talking, or 5%. They were talking about 6% in Florida. It just made zero sense to me, because people are moving to the Sunbelt areas because they can move for their job, right? You can go and work from anywhere now. You don't need to be in the office with a lot of different companies, not all of them, right? But with a lot of different companies, they're allowing people to work remotely. So due to that fact, it's let people, like I decided to move down here to Florida for freedom and get away and make things easier on my kids' life in school. A lot of other people did the same. But people that were working jobs that were now able to are flocking down to Florida, to Tennessee, to Texas, to Arizona, right? The Sun Belt in there. These are the states they're looking to go to. That's where people want to retire to, especially Florida and Arizona. And the Carolinas are really getting a nice bump as well. But if you look at 2022 here, you get a nice little bump here in January. Slight drop here in February, but since mid-February, it is taken off. This is almost a hockey stick the way it's going up. And in April here, I don't think it's going to slow anytime soon. The mortgage rates are going to cause it to bend a little bit. But if mortgage rates drop again, this will continue to shoot up, because people will be able to afford more. So great chart to look at. This one really caught my eye. And then if you look at the median asking price year over year, you're talking about a year ago, the median asking price was $350. Now the median asking price is almost $400,000, $399,450. That's a 14.6% year over year increase, just a huge, huge increase. Now, this is where you really get into the data and really see the difference in price. So let's look at this time last year, 2021, get into the same time frame here. We were probably around $1,700 for an average mortgage cost. Now we're up to $2,234 at the end of March, and that guaranteed that's closer to $24 right now, where rates are currently in April 25th. So we're probably in that 24. So that really is going to change things, right? If the rates drop a little, that helps, but if not, that's changing things. So It could be that we just have people that were sitting on the sidelines and now are really pushing to buy because they're scared rates are really going to go up, get up to 6, 7, 8%. And historically, the average interest rates in this country are 8%. 8% is a good rate historically. So we're complaining about 5.11 right now. You go back, 12 years ago, we'd have been super happy with 5.11. So that's where things are right now. And that's one of the drivers in the market. One of the biggest drivers, though, is obviously inventory. And that continues to be at all-time lows and continues to get lower and lower. And with interest rates jumping up, that just causing less people to list, which is further reducing the interest rate and still pushing people to pay more. And I think we just have so many factors, guys. There's not just one, there's like 20 different factors that come into play. I know a lot of people sitting on cash that are now buying a lot of properties. So interest rate's not a factor to those people. Interest rates are not a factor to a lot of self-employed people who can afford to pay more for the property that have a lot of cash that reduce their monthly mortgage payment. But to your average Joe, big factor, right? This is really going to affect them. So pending sales are up almost 1% year over year, which is crazy considering. And they're finally dropping now. We'll get into that in a further chart here. That's crazy considering how low the inventory was, because you see the inventory, the new listings dropped 7.4% year over year, but pending sales were up. Very interesting, which just shows the activity. Active listings of home for sale down 22.3% year over year. They're just free falling. So you look at these charts here from 2020, watch the inventory just dropping, 2021, watch inventory just dropping. Into 2022, it continues to drop, but it looks like it might be flatlining here, right? Might be flatlining. I wouldn't be surprised to see a slight drop here in April again, and then flatline. And then if interest rates creep up, expect maybe inventory to start to creep up. And as inventory creeps up and interest rates creep up, obviously demand drops and prices plateau, flatten, drop at some point. I don't know if that's going to happen in 2022. The rates really have to get probably to 6.5%, 7% before it's enough to deter people from looking, or even 7.5%, 8%. It might be that much that it deters people from looking, because the numbers are they're just moving too quickly right now. As far as lack of inventory and the home buyer demand right now is just far too high for people for this to slow down. Okay, so 59% of pending sales went under contract within 2 weeks. Really, really, really quick. So almost 60%, just under 60%, went under contract within 2 weeks. 45% of pending sales under contract within 1 week. Just crazy numbers right there. Staggering numbers. Home sales sold in a median of 20 days. So you don't have things sitting on the market, right? That's why you don't have many price drops when things are, a lot of times people are pricing them low to then get a ton of people in there, and you get a bidding war which goes way over ask price. That's what's happened in certain markets. I'm seeing it and all over the place. And there's a lot of different markets. And again, only 3% of listings had price drops. 51% of homes sold above listing price. Just crazy numbers. I mean, last year at this point, we're 40%. So you're 11.2% above that. And so here's where we're starting to get that little bit of an increase in price drops, right? So you had that in 2020 going up. In 2021, you did not. It cratered. Price drops just didn't happen. But you're starting to see this. This is an interesting graph right here. Just looking at all these numbers, how it's increasing in 2022. So you started to have a drop and then an increase in from, call it 2.75 down at 2.5, up to just about 3%, to exactly 3% here at the end of March. Really curious to see what happens in April. I do expect this to continue up in April, and then maybe slow in May and June. We'll see. It's where things get really, really crazy. And then you go into the average home sold for 102% of list price, where let's go to last year, we're slightly over 100% of list price, 100.2. We talked about that a little bit earlier. Redfin Home Buyer Demand Index up 5% year over year. So the home buyer demand is up 5%, still climbing, still climbing. So it's almost like you have a panic for people rushing into it here. So now let's get into the more updated here. This is all throughout March. And you see the median sales price, just unbelievable here. Median home sales price, $412,156. That's your median home price right now in the United States. 412,000. Unbelievable how much that's increased. So you had number of homes sold drop 7.8% year over year, and that's due to less inventory. And then the interest rates up 1.1% from last year, right, to 4.2 at this point, at the end of March. So very interesting numbers there. Housing demand continues to go up. Homes that sold above listing price, 54.3%, 12.3% increase year over year. Home price drops up 7.2%, up 0.08 year over year. So barely an increase of the price drops. Sale to list price, 102.4%, up 1.9, almost 2% year over year. So very interesting numbers there. Now let's go to the home buyer competition here. Home buyer competition drops for the first time in 6 months. This is as of today, April 25th. I want to pull up some real live data for you guys so you can see exactly where things are going here. But 65% of home offers face competition in March, down from 67% in February. And it should be moving the opposite direction. It should be going up in March compared to February. So it tells you what rates have done and how they've dropped demand here and where things could possibly be going here.
How would you like to have a full or part-time business that allows you to create a flexible work schedule around your busy lifestyle? Would you like to earn between 60 and 500,000 annually working from the comfort of your own home? If so, then virtual wholesaling may be the business for you. Contact us at reoauctionacademy.com and find out how to get a jump start on building a cash flowing machine without the headaches of dealing with contractors and homeowners. With an investment starting as low as $7,000, you can be well on your way to living the virtual investing lifestyle of your choosing.
Hello, everyone. Welcome back to part 2 of our real estate market update here for 2022. Again, we're at the end of the first quarter, April 25th here, 2022, to get the timestamp on this podcast. And I want to dive deeper into some numbers here. I'm going to bring up an article where somebody who's a big real estate investor in Florida thinks the market is, where I think it is, where I think it's heading, and where everything is heading in total here. Obviously, it has to feel like we're at the peak of the market. And to me, it absolutely feels like we're there or heading there. I thought we were going to be there a year or two ago, but it continued to just push up further and further and further. But with rates creeping up, and obviously, and all the numbers I've been showing you here, I do think we're getting into the peak. I think it'll peak out this summer and then it'll slow a bit. I still think it'll carry forward and be a fairly hot 2023, at least the beginning of 2023. And then from there, fade out. We'll see how this prediction goes. But obviously, if rates really shoot up and get into the 7s, that changes everything. And the market will turn quicker than I thought. And we won't have this prolonged period of time of buying and increasing in price. So right now, I think we're about to peak, and we'll probably peak out in August of this year, maybe September, before we see things slowly start to decline or flatten or decline end of the year into 2023. And that's when I think the market totally changes and we start to go on a downward trend, especially if rates continue to increase. It's obviously all rate driven. Cheaper the money, the more people can afford. The more expensive, the higher the rate is, the less people can afford. And it's fairly simple. If you look at the prices right now with the median home price, from April 2021, the average mortgage payment was $1,700. As of right now, April 17th, the average mortgage payment is $2,318. And it has even climbed slightly in the past week. So it's probably somewhere around 24, just under 2,400. It's called $2,350 per month right now on your average mortgage payment, which is really, really high from where it was just a couple of years ago. Before I get into those numbers there, I'll dive deeper into that part, let's look at the home buyer competition, which has dropped a little bit here as rates have increased. So you're seeing it go down from 67 to 65, and that should continue to drop as rates are increasing here. You see we're at our highest levels since 2010. But if you look at it, you go back to 2000, when we were down 8 and shot up to 8.5, and then started going down ever since with the Federal Reserve dropping rates. That was around the getting close to 9/11, right? Here is 9/11, roughly right in here. And that's where you see the big drop off, right? And that's where rates really dropped and then went up and really started steadily decrease there for a while. The housing market really took off 2002 to 2007, call it, and peaked, I believe, in 2007, and then 2008, obviously the economic collapse. And then we went into a big time down market, probably the worst real estate market we've had in a long time, or since the Great Depression. And then, rates have steadily decreased, occasionally shooting up, but not very much, right? And then going down again. And then we hit our all-time low here in January, and even in early February, it was great. And now look at this. This looks like a hockey stick, right? And again, you can attribute a lot of this to the Ukrainian war, Ukrainian and Russia war, really boosting this up. And I think this shot up, I think this overshot, I think you see this peel back a little bit. If it does, that extends the timeline out that I was talking about of a decent market. If it gets anywhere near what we had these lows down here at 2.65, we will definitely continue this heated market for a while. But if it continues this trend up, that's going to shut the spigot off, because this is a basic macro, right? We're going to look at a lot of macro numbers. You can always go to macroeconomics and follow these charts, and they're going to tell you exactly where things are headed. We'll throw some micro factors in there. And obviously the biggest micro factor here being interest rates, which is the biggest driver, which is going to change the market and home affordability. Not just that, but let's throw in inflation and everything else, from cost of renovation, cost of food, cost of fuel being number one, which makes everything more expensive. So the cost of clothing as well, everything is going up. So the more your day-to-day costs go up, the less you can afford as a home as well. So let's not forget about that factor coming into play. Now let's look at the most competitive markets in the country as of the end of March here. And we got a few of them here in California, San Jose. We got some in Massachusetts as well, Rhode Island. Again, a lot more in Southern California and San Francisco, San Diego, San Francisco, a little bit of Washington. Colorado has been a red hot market for a long time. So is Charlotte. And I was kind of surprised to see Philadelphia and Minneapolis on this list here, but hey, they are hot markets as well. Everything's hot just because there's not enough inventory. When you have constricted inventory, this is what you're going to have. You're going to have these markets really, really, really increasing. And you see it all the way going down. Nashville, Tennessee, I'm still super bullish on. That's going to continue, I think, for a little while. And anywhere outside of Nashville to 30 minutes to an hour outside, I think will continue to grow as well. Let's get into some of my favorite charts here. So you got obviously the median days in market, which you see just continue to drop, just go up a little bit here and then just drop. And that'll probably continue to drop as inventory drops. The median sales price, this is going up like a hockey stick way too quickly, right? We were at 280,000 in 2019. In 2020, we were at 290 here, 285, 290, 289 in 2020. And now we're at 413. That's way too much, way too quick. A 17% increase year over year. And that's nationally. I don't think we'll repeat that this year because of interest rates. If interest rates would have stayed low, we would have repeated that, not only repeated, but beat it. I think Florida will excel and do greater than it did last year. I think this is the next big year for Florida. And then you see the drop in Florida. And again, remember, all these markets that get pushed up too quickly are the ones that get corrected quicker too, right? So the markets that go up the most: California, Bubble City, that's going to have a major drop off. Vegas always does. Phoenix, Florida, these markets. And when I say Florida, I'm talking Miami, I'm talking like Fort Lauderdale, the high-end expensive markets, Palm Beach, Naples, These markets will be your first affected. Your ones inland who didn't go up as much will not be affected as much. Tampa is going to get affected, and Clearwater, that area, because they've really pumped. They've really gone up. So these are the markets that are really going to get hit more so than other markets where, Midwest, whether it's Indiana, Ohio, Missouri, Kansas, Oklahoma, even Texas, I say outside of Austin, which will get hit a bit, and Dallas will get hit a bit. But there's so many jobs in those markets that they won't get hit nearly as badly as other markets will. Texas is super friendly to business. So that always have jobs and good income there. So people will be moving there. Same with Tennessee, same with Florida, like I said, to an extent, but there's not as many jobs in Florida as there are, because it's a retiree state, as there are in Texas. So I expect Texas to get hit far less and recover much quicker than other areas. Again, rates are going to be dependent. If you see rates shoot up in the double digits, this market will tank like something you haven't seen in a long time. It'll be potentially almost as bad as the financial crisis in 2008, just because rates will have gone up exponentially so quick. But I don't see that happening. Federal Reserve will do everything they can to buy that 10-year T-bond down to stop that from happening. They don't want to collapse the real estate market. They don't want to collapse of any market. They just want to pump every market up more and more and more. And that's why I see like the stock market having record highs. Cryptos will hit the record highs again. And real estate market's going to hit its record high this year. And then we'll see what happens in 2023. We'll revisit that whole thing again. But looking at these numbers, obviously the mortgage rates, you're seeing this big increase really quick. And let's hope this corrects and comes back down so we don't hit this cliff, a financial cliff here. But obviously, if war continues to break out and gets worse, this will probably continue to increase even further and further and further. All right, now I want to get next into, this is one of Florida's biggest real estate investors. He's a billionaire, and what he thinks, and I'm kind of lockstep with him, what he feels about the market. He thinks it's really hit its peak or just about hit its peak. And it's going to, at the end of this year, he thinks prices have gone up more than anyone could ever imagine, which I totally agree with, way more than I could ever imagine. It still blows me away to see $413,000 as a median home price. It's just unaffordable for most people, way too unaffordable. So with that being said, I totally agree with him. Prices are going to correct, even though there's so many cash buyers in this market and so many cash buyers in Florida and in Arizona and in California, in these big, high, expensive markets. It's amazing how many cash offers are coming in. So despite the fact that rates go up, these markets will have a little extended period of juice left because there's so many cash buyers in those markets that want to move or selling their property from the Northeast, say, or from the Midwest and moving to retirement area. Or warmer weather into the Sun Belt. So I'm in lockstep agreement with him on this. I do think the prices are going to level out and really change over the next year or so, and we'll see where it goes from there. All right, guys, let's take one more look at the Florida housing market, because these numbers are pretty telling how much the market has heated up over the past, call it, year and a half. 2 years here, where the median home price is $389,100. So you look at the state from in 2021 and 2022, up almost 23%, 22.7%. And I expect somewhere between 16 and 22% as my prediction in December for Florida in 2022. We'll see if that holds true, because we were well ahead of that. We're over 25%, I believe, right now. But with interest rates changing, it's going to throw everything, into headwinds. I'm going to beat a dead horse here. Interest rates are the biggest driving factor. So that's the biggest thing we got to look at. But where has the growth been? And you look at some of the biggest growth areas: Palm City, Florida, right? Punta Gorda, Davenport, Newport Richey. I see a lot of investor deals coming in Newport Richey, and they are flying off the shelves. One of them that came through from a wholesaler to me this morning sold in 2 hours and got over ask. Margate, Florida, Clearwater, Florida. I right now have a package of 4 duplexes in Clearwater that I bought from a fund that was looking to liquidate. And initially I was thinking maybe I'd buy and hold these things, but I'm not. This market, I'm just going to put them on the market. I'm picking them up on average around 230, we'll call it 235 on the average price here, 232. And I'm hoping to sell each of them for 300K, somewhere in around the range, somewhere between 275 and 315, call it. I'll be happy anywhere in between that. So we'll see where it goes with those. And again, that's something we teach. If any of you guys are interested in learning more about how to do what we do, you can reach out to us at reoauctionacademy.com. That's REO auctionacademy.com, or fliprealestatevirtually.com is another one. You can join our monthly calls for just $97 a month on that. You can learn how to do what we do for do it yourself at home course, $497 for the front end, for another $497 for the back end on how to resell properties. Or you can join our coaching program right now. We put on special for $5,500. Feel free to reach out to us. We talk about this data on our coaching calls. We are constantly going over this, make sure our students know what's going on. And we are seeing, despite the fact that you're seeing record low inventory everywhere, we are starting to see big inventory increases in the auctions, and we have little and no competition going with our properties. And we're seeing some of our biggest spreads right now on properties. But it's not just the auction companies that we go for. We end up getting a lot of off-market MLS deals because we build so many relationships with agents and REO agents that they bring us deals that are off-market. We get them under contract. We can occasionally assign the contract, but usually we take those down and we relist them for bigger dollars, right? In this hot market, the way it is here, we do a bit of wholetailing. So we teach you guys how to do that. But a lot of what we do, we're going over this data here, right? So this data is super important. And that's why we go over it. And that's why we go over it with our students, right? So let's look at the number of homes for sale. There's only 95,583 in the entire state right now, homes for sale, down 24.4% year over year. So in our county, Collier County, normally there's 4,000 homes available on the market. And it's actually more than that on a typical normal market. Right now, we have around 600 or so in the market. So you can see how low the inventory is and why things fly off the shelves so quickly. Why it's important to get good off-market deals, which we teach you guys how to do here. But as you can see, these numbers are crazy. And that's part of the reason you at 23 days on market, on average, 1 month supply, it's a healthy real estate market is a 6 month supply of inventory. So we're actually under 1 month with what we have here. So very, very, very competitive market. And I expect that to continue throughout the year here and maybe even early into 2023. We will see. Now, let's go into the latest Yahoo article came out in Zillow, how they just did they revised downward their forecast. And they're hedging themselves and they're smart because the interest rate shot up. And they're trying to get ahead of themselves because they're originally calling, as you see here, for prices to go up 17.8% year over year, which I totally agree with. They had Florida going up 15%. I had it, like I said, between 16 and 22. So I was a little more bullish than they were. Nationwide, I was a little less bullish. I was more in a 15% range. And they actually just downwardly revised theirs down to 14.9% for March 22 to March 23. We'll see what 2023, we'll see what it actually ends up being. And when they talk about it here, it's driven by interest rates. The 30-year interest rate that Fannie Mae forecasted, they figured by the end of the year, the interest rate would be 3.3%. So we've blown way past almost 2%, 1.8% higher than that right now, currently in April 25th. So here I have highlighted at 3.11, the average mortgage rate on a borrower in December here for a $500,000 mortgage would be $2,138. Now that payment would be $2,718 at a 5.11% rate. So basically you're adding a fairly expensive car payment, almost about $590 difference roughly in a monthly payment with this interest rate change. So you can see how quickly that can change the markets and how quickly they change their forecast. And if rates continue to climb, they will continue to drop this further and further and further, as I would mine too. But it's always good to stay up on top. If you're an investor, you need to stay on top of these numbers because these numbers tell you a lot. And what these numbers are telling me now is to reduce the number of fix and flips I'm doing, even the reduced number of wholesales I'm doing, and go back towards that wholesaling model. So that's what we're doing. We are pushing as many properties as we can, just wholesaling them, partly because the cost of materials, the cost of labor shortage, material shortage, the amount of time it takes to get these properties, the increase in the interest rates, which makes all your costs go up exponentially more. So our thought is, all right, market's still hot, sell them to another buyer, let them deal with all those issues, take a smaller portion, pick and choose which ones you want to do the bigger scale fix and flips in logistical markets that you want to be in, and maybe ones that are a little more insulated where you have more exit strategies, whether it's not just a fix and flip, but maybe a buy and hold. Maybe you can cash flow that property because you want to have multiple exit strategies. If you're buying in a market where only thing you can do is fix and flip, and you can't secondarily have it as a cash flowing rental. When I say cash flowing rental, refinancing the property, getting all your money out, or most of it, preferably all of it out, it was what I look to do, and still net $300 positive cash flow per month after paying a property manager. That's the only way I'm looking at picking up different properties and doing a longer term fix and flip. If I can't have two exit strategies like that, then I don't want it, right? I'm not interested in property. And my primary exit strategy shifted from wholetailing this year to now wholesaling. We're going to really shift our model. We were 80% wholetailing. Now we're going to go back towards our old model, not quickly, but we'll get there, back to the 80% wholesaling model as the market shifts. When you're in a down market, and we've done better wholesaling in the down market, and of course, wholetailing and fix and flipping in a hotter market. Again, we're still in a hot market, but there's too many different factors, micro factors, that can change this market too quickly, as we've seen here in the last month with interest rates really shooting up, that make me pull back the reins a little bit and try to stay ahead of it. I don't want to get caught in that crunch I got in 2008 when I had all these fixed flips going on, and all of a sudden the buyers fell, right? They were gone. There was less buyers out there. So I've already talked about that before in the past. So always have multiple exit strategies and know what you're going to do, and know when you're going to be able to get out of that market and how you're going to be able to get out of the market quickly, confidently, and get your private lenders paid. And if you're using national lenders like I do, I use Kiavi, I use Lima One Capital, I use Dominion Financial, I use Lending Home. I want to be able to pay these guys off and not have to worry about switching to long-term financing and holding a rental that's not a cash flow one now. And I worry about this long-term. Normally in a market, if you could do that and pull most of your money out, which I did in the last cycle, and then hold it, market goes up, you get your money back. I just am not that confident holding it for 5 or 10 years after these big run-ups we had, that we're going to have price increases in the next 5 to 10 years. I just don't know how we could do it, right? I don't know how the way people are, we're already past the home affordability index. So how does it continue to go up unless wages really skyrocket and people are making way more money, which that's, sounds like pixie dust to me and fairy dust. So I don't think that's going to happen. So I don't want to hold anything long-term. I'd rather cut my ties, take a loss, and move on, and then see what the market's giving me over the next few years and adjust from there. So I hope this has helped you out, guys. A lot of info here to take in here, a lot of macro stuff we looked at here, a lot of micro stuff. The charts are so important. Follow these charts, know what they're giving you. I'm going to stop the share here, so we're done with that. But know what the market's giving you, and know when you need to be able to get out of the market. All right, guys. Hope you got a lot out of this, and we'll catch you in the next episode.
You've been listening to Flipping Out with Paul Ezell, the #1 success platform for virtual wholesalers. Visit our website, thevirtualinvestor.co, for more information about how you can leverage virtual wholesaling to take control of your time, enjoy financial freedom, and live life the way you've always wanted to. Join us again next time for another informative discussion right at your fingertips.